November has been an amazing month in financial markets. Certainly not a day goes by where the media doesn't report on the declining equity markets, and in particular what's going on with financials. Which bank has declared the largest loss in the previous 24 hours. But the move that's been dramatic but underreported has been in the U.S. bond market. Since June of this year, U.S. bonds have moved from a yield of 5.3% to a yield of 3.8%. A huge drop. That 1.5% drop in yields implies a 10% increase in prices. Now, where did this drop in yields come from? Well, there have been three players that have contributed to this drop in yields. Firstly, and undeniably, there's been a movement to safety. People want to buy government bonds and wait out the volatility in the market, hoping to find an investment opportunity in the future. Second has been the hedge funds, particularly those in the technical and quant space. And as the market started the trend, they've continued to buy into that trend, exacerbating that move. And finally, it's hedging. Hedging that's taking place by both banks and mortgage issuers as they're trying to shore up their portfolios. Their models tell them to continue to buy as bond prices increase. What does this mean for investors? 3.8%. After taxes, after inflation, you aren't making anything at all on your fixed income investments. For investors, they should be selling bonds. This is their opportunity to sell bonds at an attractive price. Now, what do you do with the proceeds? There are two options. One is that you buy short-term investments, which currently yield more than bonds, or, in our view, is that you start buying equities. If you look at equities and how they're priced today, at 13 times earnings on the S&P, and the 13 times earnings on the S&P is for the S&P excluding financials. So if you're looking at your investment universe and you say you exclude financials, we're at levels we haven't seen in years in terms of how cheap it is. You're being paid almost 3% more than treasuries to take on equity risk. So bottom line is that you're being paid to take equity risk at this juncture, and you're not being paid at all for the safety of government bonds.
You